In our first video, Investing for Safety and Maximum Return, you were given some important tools to help you evaluate stocks. However, evaluating stocks is just the first step. You also have to get these stocks at the right price. Many stocks are overpriced, while others are traded at a discount. Regarding stocks that are fairly priced, Peter Lynch tells us, the price-to-earnings ratio of any company that's fairly priced will equal the growth rate of its earnings. If the price-to-earnings ratio of Coca-Cola is 15, you'd expect the company's earnings to be growing at about 15% a year, etc. Lynch refers to the price-to-earnings ratio, but what is that? The price-to-earnings ratio is simply the stock price divided by a company's earnings per share. Current price-to-earnings ratios for stocks can be found on the internet. As for a company's growth rate, you can calculate this by using the formula provided on the website shouldersofgiantsinvestors.tripod.com. As stated before, a company that's fairly priced will equal its growth rate. As good investors, it is our goal to find stocks that are selling at a discount to their growth rate. As for how much of a discount we should be looking for, Warren Buffett and Peter Lynch suggest a target of 25%. With this in mind, suppose that you find a company that meets the quality standards outlined in the video Investing for Safety and Maximum Return. And suppose that this company is growing at 12% a year. To achieve a 25% discount, you should purchase this company at a price-to-earnings ratio of 9 or less. Buying companies at a discount is one of the most important things that you can do to maximize the return on your stock investments. Finally, a word on fast-growing companies. These are companies that grow earnings at 14 to 25% or more a year. Many fast growers that trade on the stock market are overhyped and overpriced. Regarding overpriced growth stocks, Peter Lynch has this advice. Any growth stock that sells for 40 times its earnings for the upcoming year is dangerously high priced and in most cases extravagant. As a rule of thumb, a stock should sell at or below its growth rate. Even the fastest growing companies can rarely achieve more than a 25% growth rate, and a 40% growth rate is a rarity. Such frenetic progress cannot long be sustained. Peter Lynch adds, the best way to handle a situation in which you love the company but not the current price is to make a small commitment and then increase it in the next sell-off. One last point regarding fast-growing companies. Fast growers tend to be small, under-financed companies, and because of this, they risk extinction should they run into problems. As a safeguard, you should tighten up on your debt requirements for fast growers. You want to see at least twice as much equity as debt. In other words, with growth stocks, you're looking for a debt-to-equity ratio of 0.5 or lower.